From the morning reading. The spider pulls back from high, stays above support. Healthcare leads, the SPX, the INDX lower. The VIX jumps, oil falls. All 9 sectors moved lower on Wednesday. XLU, XLF, and XLP were the strongest sectors, while XLV was the weakest sector. Oil futures fell 77 cents to close at 46.80. Oil is forming a potential bull flag. Breadth weakened compared to the prior session as decliners led 2085 to 884 on the New York Stock Exchange and led 1680 to 884 on the NASDAQ. IWM pulled back from Tuesday's higher high, making day one of a potential bull flag pattern. Spiders, Qs, and diamonds sold off to their short-term support of their current 14-day sideways channel on Wednesday. At Wednesday's close, Spider is down just 0.8% from Tuesday's new intraday high. Gold fell $14, its largest one-day drop since August the 5th. The S&P 500 went from nearly a record high to wiping away weeks of gains. When stocks coil into a tight range like they have twice over the past 2 months, such activity becomes more common, and it's happened twice recently. A multi-week low tends to send shivers through the media, but in reality, a move like Wednesday's has had little meaning. Gold is now in a medium-term downtrend, at least if one uses the 50-day average as a guide, which many do. For the first time in more than 2 months, gold closed below its 50-day, only the 4th time it went this long since its bear market began more than 4 years ago. Historically, losing its 50-day average after months above it has led to further losses in the short term. Wednesday's drop pushed optimism on gold miners to an extreme low. The optimism index on the GDX and GDXJ exchange-traded funds fell to 2, the lowest reading since July of 2015. Since 2007, when the optimism index for GDX fell below 3, it tended to follow through to the downside in the very short term. It was higher 3 days later 48% of the time, but was higher 3 weeks later 83% of the time, or 24 out of 29 events. Its median drawdown was nearly minus 5%, however, so this was a high-risk, high-reward trade. The suggestion would be that if gold miners fall apart several percent over the next few days, it should lead to a 2 to 3 week rebound. On the S&P 500 snapshot, a down day as Jackson Hole Friday draws closer. The S&P 500 opened lower in a continuation of a trend that started after yesterday's intraday high in the early trade. A half-hearted reversal began in the late morning but ended with the lunch hour. The afternoon selling accelerated to a negative 0.72% intraday low shortly before the close. A bit of last-minute buying trimmed the loss to a negative 0.52%. Weakness in oil may have been a factor in today's market. End of the day spot crude fell 2.77%. Meanwhile, as we observed yesterday, the general view among the pundits is that equity markets are awaiting the Friday flavor of Fed Chair Yellen's speech at Jackson Hole. Hawkish, dovish, or a confusing mix. The yield of the 10-year note closed at 1.56%, up 1 basis point from the previous close. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:05 a.m. Mountain Time, and I am recording this in preparation for the market day of August the 25th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of this cut, we've got a little bit of weakness, but nothing significant. All 4 U.S. broad-based indices are down a bit below scratch. Crude oil is down about 1/3%. Euro is up about 1/4%. Bonds are down about 1/4%, and gold is down about 0.5%. China down about 0.5%. Hong Kong right at scratch. Japan down about 0.25%. Germany's down approaching 1%. United Kingdom is down just below scratch. And Thursday's macroeconomic reports for the United States of note, you had the weekly unemployment claims and you had the core durable goods orders. And you'll also have nat gas storage. And of course, that Jackson Hole Symposium has begun. In terms of looking forward to tomorrow, of course, you're going to have that Fed Chair Yellen speaking from Jackson Hole, as was referenced in the morning reading. You also have preliminary GDP and University of Michigan consumer sentiment with inflation expectations. In terms of current volatility conditions, VIX did get a little bit of a pop yesterday, and short-term VIX is now at a 12.67. Skew actually has ebbed in recent sessions. We're down to a 130.43. Still in caution stance, but not particularly heavy on the warning threshold. IV percentiles are rising, but still extremely low. The S&P is at a 9, the Russell at a 15, the NASDAQ at a 10, and the Dow at a 9. We did have standard deviation moves put in yesterday on a close-to-close basis on 3 of the indices. Only the Dow did not participate in the big loss in that terms of that relative degree. In terms of the charts, let's go ahead and go over there. So you can see here on the S&P futures charts yesterday's action, and you have a bearish engulfing on the S&P futures, and you also have continuation. So this pattern seems to have confirmed, and we're certainly going to look like we want to test, some leg down. Now remember, until you even get to 2165, that's kind of your first level of some significant support, and then more significant support down here around 2141. But you've really got to put this in context all the way back to this point here where you had this reversal pattern, and we went from 1982 all the way to 2191, some 200 plus points, with nary hardly a retracement of any note at all. Certainly nothing big enough to even be a small fib retracement. So basically, a minor pullback day, a minor pullback day, another minor pullback day, an intraday reversal. Up until yesterday, nothing really that meant much. So we could actually drop, a bit more before we would even put anything of a serious challenge to the bullish trend here. So don't let this get ahead of you. And in fact, for some folks who have not participated in these breakouts to these new highs, this could present an opportunity to be able to jump on or to add to positions if they were too light. So we expect that these pullbacks will be stopped and that there'll be nothing more than bull flags until proven otherwise. That being said, I'm not going to be surprised if this is a little deeper pullback, given that the last several have not done anything of note. And frankly, we've not even challenged the all-important area of resistance, now turned into support as of yet. We had a kind of a feint at it, but no serious testing of that level of support. And it's kind of hard to believe that at some point we don't test that level. So whether this is the time or some future opportunity, bottom line is that we're not going to get too worried or too excited about a pullback as long as it remains, within kind of expected ranges. On the Dow, very much the same pattern as the S&P, and definitely had, a bearish reversal pattern, which is now fallen through. And, we're testing the bottom end of the recent range. And frankly, if you draw a larger range around, all this sideways consolidation, we're just, in the middle of that range. NQ or NASDAQ, NASDAQ, of course, has been more bullish, but did go sideways in recent trading. Also had a bearish reversal pattern. And I suppose we probably would call that dark cloud cover, but then certainly is also having a continuation to and confirmation to that pattern. And then Russell also had its intraday high put in, just a couple sessions ago to just immediately have this bearish reversal and then continuation to the downside. But still just kind of smack in the middle of its former range action. Crude oil, of course, has been very much an instigator of late, and it has definitely shown some weakness, and down into the cloud is in a neutral pattern right now, and could be in something of a bull flag pattern. Crude oil has not had the easiest chart in this last year. While it is generally resolved to the bullish side, it is sometimes really tested the merits of the bulls and some pretty deep thrust, kind of overthrows before finally resolving back to a bullish stance. And you see we still haven't taken out these former swing highs back here from June. So a more complex pattern, and perhaps, if we were to take all this context, we're in a big giant sideways consolidation pattern after being so bullish for so long. So right now we're waiting to see what we do with that. We had this series of lower highs, lower lows, and then broke down out of a wedge, and then that then was overthrown and then back up towards the former swing highs, but didn't quite make it. So this move was pretty quick, pretty violent, and then yet didn't quite make it to the target, and then it started a retracement. So the question is this just a bit of a retracement before we actually do take out these former highs from early June? I kind of suspect that that might be the case, that we might be just forming something of a bull flag pattern, and then we'll reverse and then not just take out this swing high, but we'll make a serious effort at these swing highs. But it could be really difficult to estimate how much time that will take, and also really difficult to estimate the success rate of being able to take out those highs, as this has been a difficult chart of late. Another difficult chart of late has been gold. Just when you think gold is really going to make a break for new highs, it goes into these prolonged consolidation patterns, and has broken with yesterday's action its 50-day moving average line, as you heard one of the morning authors speak to. Though from a general support area, while we've had in the short term some lower lows, lower highs, we still haven't kind of taken out the primary lows of the pattern. Even if we did with gold, as we've seen here, we finally had this breakout, but then look at this, this messy pullback just to rip the faces off of the bears and then take it up, and very quick action to these highs. Gold seemingly has had this, and I don't know if it's the algo traders or what, but it seems to kind of come down and kind of overshoot, run all those stops, and then take off and then continue its bullish patterns. And I'm somewhat suspicious that we may be doing that again, that we may even break down into the cloud here and break these lows, just to then turn around, and then perhaps a month from now we're talking about gold 1400. But much like crude oil, a very, very difficult testing type of trial for the bulls to get there. Let's take a look at bonds. Bonds, they're still neutral, still in the cloud, still have not broken out. And then, of course, let's take a look at VIX. VIX has been breaking up a little bit, but, nothing dramatic yet. Certainly not getting too excited. Let me take a quick look and see for sure that we're still in that VIX daily squeeze. Just a second. Yeah, just a second there. I did check to see on the VIX daily squeeze charts. That's a special chart on a different platform on my monitors here. And we are indeed still in that VIX daily squeeze. So while we're starting to perhaps pressure that squeeze, we've not yet, busted out of the squeeze area. So that has not yet fired. But at some point, we're going to see volatility tick up. And, it was right at a year ago that we had the August, significant drop. We're coming into Labor Day. It's about that time of year where volume starts to pick back up and so forth. So again, not going to be surprising if we see something of a pullback in the indices or something of an expansion in volatility as we come into early September. And more market participants are at their trade desk. So some things to think about. Very difficult to estimate the timing of these things, but we're just looking at what potential outcomes could be from the current chart patterns, and then from those outcomes, what might be an area in which is kind of an acceptable area to run to without kind of destroying the overall bullish expectations of the current patterns. And where that might be starting to break down and start to show us something more significant is occurring. So that's kind of where we are with this effort right now. So I think that's probably enough time on the charts right now. Let's go ahead and go to the daily report. And let's get that resized for you. There you go. So first of all, market intermediate term phase opinion, still phase 3. We still have the expectations of bull flags until proven otherwise. And that certainly hasn't been invalidated as of yet, even with this little bit of a test. And it is a very small test so far. But we are starting to see some signs of change. And you hear me talk about change and the rate of change. Well, here in our 3 market timing signals, we've had the stock chart's decision point go with mixed signals on the short term, a few sessions ago. Well, now here is our second significant change to the market timing system. This one from IBD. Their system is now going to uptrend under pressure. So much more of a cautionary stance. GMI index still with its buy signal, and it has been in place since 7-1. Also, GMI 2 is at a 5 out of 8. It deteriorated a point yesterday. And then the third one, of course, has been at a mixed signals on the short term and the long term. So a very, very kind of poor bullish overall signal, because we primarily focus in our efforts with the intermediate term. So when you put the consensus of all this together, it's still an expectation of a bullish bias, but clearly some continuing deterioration, and that change is starting to seemingly pick up. Position sizing opinions, actually I left this, it should be at 50% on this first one. Portfolio investors position sizing opinion, it should be 50%. Volatility still at 100%, or could structure this as a 75 to 100%. So starting to see some changes come into play there. We're also starting to see some change come into play in the intermediate term market posture. And you see the Dow has now gone into a weak bear intermediate term market posture. The S&P, if it drops below an 80, will go into a weak bear intermediate term market posture. And that's the most important index, and that will totally change our signal. Now, this is all still supported by a bullish sentiment line. That's a longer term, less sensitive line. And that still is in a bullish posture. So that will continue to help the bulls have probably weak bearish legs at best, and then more longer and prolonged bullish legs in general. But doesn't mean that we can't break and perhaps even be healthy for the bulls to be able to have a bit of a retracement, a little bit of an exhale from the market, and then to accumulate and off again with another bullish leg. That is a normal process. Of course, the question is as we see these changes develop and these changes prolong, we start to wonder if we're being tested beyond the norms. And right now we're just looking for bull flags until proven otherwise. But if we are proven otherwise, then we start to examine where it might fall to. Strength of the trend is still very bullish. Notice this, hedge warning status. We've had a change here from yesterday. We're now at level 1, the caution light. So if you think of the red light, that means that we're in that position where, we're going through that intersection with, heightened sensitivity of vehicles coming at us from various directions. In this case, the market is starting to degrade a bit. Not seriously. This is a long way from hedge risk level 3, but this is potentially the beginning of a process of elevated risk. So VIX is still acceptable to initiate new positions for novice traders in the option income strategies, and we're still acceptable to initiate new positions for cover calls and put selling, but I would suggest being very limited in those initiations till we see this kind of shake out a little bit. It could be an opportunity for some new setups as those individual positions set up, if indeed this is a bull flag. But watch to see how this develops and be really picky about your entries, because given how long we have gone without any kind of significant retracement, this retracement might be something deeper than a day or two. There's that potential there. In terms of change and rate of change, again, look at this volatility area. Look how much red you have here. We've had new warnings come into place and multiple new warnings come into place with yesterday. So our rate of change is starting to accelerate. Market in decline, sharp increase warning. The volatility ratio warning has now fired. It was sitting in the kind of ready to fire area for a number of sessions, but it has now, with yesterday's action, fired. Also, the distribution day count has increased. The NASDAQ is now at a 5 and the S&P at a 6. That's what triggered, in part, the IBD changing their market timing signal to uptrend under pressure. So under the trend base, still fairly bullish. Under the risk aversion indicators, though, we're starting to see changes here. For so long, we had some of these as neutral, and now 3 of these are in the risk off stance, with only 2 mildly in the risk on. Short-term sentiment, still benign. Intermediate term at an elevated position. Fear and greed index, somewhat elevated at a 70. And you see from the sector-specific, telecom, consumer discretionary, consumer staples, healthcare, utilities, materials, technology. We now have, frankly, a majority of these sectors in the short to intermediate term especially showing deterioration. So again, an acceleration of change that is occurring here. And you see nobody was positive yesterday. Utilities held stable and did not have any loss. And indeed, the more defensive sectors did hold on to their values better. The higher beta certainly lost more, as you would expect, on a day of weakness. So a lot of information here today, and we're starting to see this change and this rate of change accelerate. So this is certainly something that is getting our attention. Let's go ahead and wrap up, get this thing to publish. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers. Also note the full set of disclosures can be found at the hyperlink below. We'll see you back here for the next session with the Falcon Global Market Preview. In the meantime, manage that risk and everything else should fall into place. Good trading.